Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and I have just a few quick news items I'd like to talk about today going on in the stock market. But once again, as always, I am happy to talk about whatever it is that you folks want to talk about. Feel free to fire away with the questions. I had some interesting questions on the last live stream that I did, I think on Thursday. And I try to do these Monday through Thursday every day, usually taking Friday off to do things. I might take off Wednesday this week in order to go fishing or something like that, go hit the beach because, hey, I live in Southern California and the weather is perfect right now. We are not experiencing a heat wave like the rest of the country. If you are experiencing a heat wave, I hope you guys do stay cool. I was raised in an area where it got ungodly hot. So, yeah, the big news in the market today is that futures over the weekend were up slightly. The market opened up today, and that is rapidly evaporating here. And it looks like as we come to a close, I'm going to take a look at markets here, but I expect them all to be down. And I've been watching this. So I've been on conference calls most of the morning for one thing or another, usually industry related. There's a few kind of odd things happening right now in financial products that you may not know about or even care about, but they are saying some pretty important things about the economy. So I've been saying for a couple of months now that I feel like we're probably in the middle of a recession. We just don't know it yet. But numbers are actually painting a more mixed picture than my opinion, basically. So whether or not we're in a recession is basically just my opinion. But when we look at consumer numbers, that's not really indicated by that. When we look at bank earnings right now, even though bank earnings are down a little bit, it's not really an indication of a recession. And let's talk about why that is. When you're comparing year over year numbers, and I'm really talking about Goldman Sachs today. So two things brought the market down: Goldman Sachs earnings, probably Bank of America earnings, and which are only down a little bit for Bank of America, quite a bit more for Goldman Sachs. And there's a very important reason for that. But it was Apple's hiring freeze that really kind of caused the gains in the market to evaporate. So last week I did like two live streams saying, hey, maybe there's not as much evidence for a recession as we thought. Today, I'm back on the bad news a little bit, and let's talk about that. With Goldman Sachs' earnings, they beat forecast on trading strength, and the stock rises sharply. Okay, so they beat earnings on trading strength, but they beat reduced earnings. They reduced those sometime last month, and there are some things on here that are a little bit different, and we're going to talk about that. So Goldman Sachs second quarter earnings were up on the strength of the company's trading business as investment banking revenue declined pretty sharply. So they're making money by people making trades and by them making trades themselves. So they earned $7.73 a share in the second quarter. That exceeds expectations for analysts, but down about 48% from at 1502 from the second quarter of 2021, when it benefited from near record results in investment banking and big gains in its equity portfolio. A lot of that had to do with how big IPOs were in 2021. They may not have been the leader of investment consortiums on a lot of these SPACs and companies who went IPO, but they were a part of funding a lot of those. And we've seen that market pretty much dry up. Now, that particular moment in history was really unprecedented. I mean, he was even larger than all of the companies going public during the dot-com boom. So it makes sense that that particular slice of their business would be down when we've seen basically the IPO, the SPAC markets collapse. So shares rose 4.6% on Monday to 307.32, adding gains from Friday, and the stock rose when 4.4% in the broad rally in financial shares. Of course, that all evaporated by end of day. So let's talk about that for just a second because I haven't even looked at final numbers. But the market, the Dow Jones is down 231, about 0.7%. The NASDAQ 100 off 81 points, about 0.7%. The S&P down 31 or about 0.8%. Everything is changing here when it comes to the market in terms of like oil. We're seeing kind of a steady march downward that we've seen since about the beginning of June. We've also seen oil prices bottom out. There could be spikes here in the future, as a lot of that is dictated by the futures market. So we'll keep a close eye on that. So the big the only bright spot here, other than oil, of course, is consumer staples, and that is only a bright spot because it's been stable, not because we've made tremendous gains. There is movement in the fixed income market, meaning treasuries and other things that are derivatives of the fixed income market, particularly like annuity rates and CD rates. We're starting to see those creep up a little bit. So, and when we're starting to see them creep up a little bit, I was on a conference call today, and the rates that some companies are offering on 7-year fixed annuities are going to look pretty attractive to some people. We're looking at rates right now on those fixed annuities with surrender periods somewhere out in the 7-year range. You're looking at 4 to 4.5%, anywhere from 3.5 to 4.5% as a guaranteed rate on there. So, yeah. Let me see here. Michael Wheel says, if and when figures come out that the U.S. is in recession, how much do you think the market will drop 3,600 or lower? When that determination is finally made, you probably won't see the market drop that much. You'll probably see a 1-day drop and then it comes roaring back, because the market, of course, is that forward pricing mechanism. It's always looking to price where they think the economy is going to be 6 months, 9 months, a year out from now. So we may have already experienced most of the downward movement on the market right now. We've been hanging out between 3,600 and 3,800 for quite some time. And even more bad news, I think, is kind of baked in. I think right now the market is pricing in pretty heavily a 75 basis point rise in interest rates when the Fed convenes again, for this month, for next month rather. And I think that's fairly likely. I think there was only like a 31% chance of a 1-point rise, and the rest of that was the market is basically betting on a 3/4 point rise. So a lot of that depends on what inflation numbers look like here in the future. So the numbers that were quoted last week that were so disappointing to the market don't take into account how much the cost of fuel has gone down just over the last couple of weeks. I know this sounds crazy because I'm out here in California, but I fill up my car about twice a month because I don't do that much driving. And this was the first time I've seen it under $6 a gallon for a couple of months. So, and that's a wonderful sign. I don't know how much it's dropped across the country, but I imagine it's substantially more because California has issues with California just has issues when it comes to gas prices. But no, yeah. So I expect if that were to happen, that the U.S., that the body that makes that determination as to whether or not we actually are in recession, when they make that announcement, remember that's always trailing information. It's information that's behind by a month and up to 6 weeks. By the time that happens, the market generally realizes that and starts pricing accordingly. So typically, recessions are 2 to 3 quarters of declining GDP in a row. Right now, we definitely had first quarter declining GDP. It's still unclear whether or not we did in the second quarter. We may not have declining GDP in the second quarter, largely on the back of consumer spending. And people keep talking to me about different anecdotes about how they're cutting back spending money, but it's usually they're cutting back what they're spending on things, but they're still going out for experiences. I'm noticing at one of the businesses that I own, which is a bar and restaurant. I don't run the business, but our business there is increasing and increasing and increasing. And we keep finding new clients and folks are they're ready to go out and party and mingle after a couple of years of being blocked up here. So yeah, the big news though, that I think really affected the market was this though. Stock optimism evaporates on Apple hiring plans. And they're not laying people off yet, but Apple plans to slow hiring. And that added investor worries to the Federal Reserve's campaign against inflation, which would drop the economy into, which they think is going to drop the economy into a recession. Now, to a degree, let's remember what the goal of the Federal Reserve's interest rate policy is, and that is to slow down basically slow down inflation. And how do you do that? You do that by reducing demand. What's the easiest way to reduce demand? It's to increase unemployment. So we are at historically low unemployment rates. I don't know that they can realistically get any lower. I was just reading an article yesterday that there are twice as many job openings now as are actual job seekers in the U.S. I keep hearing from employers that no one wants to work, and I'm having staffing issues as well at a couple of the different companies that I'm involved with. And a lot of it has to do with the fact that people are just getting better offers. It's not that they don't want to work; they don't want to work for what we're paying. So we're looking at probably increase in our labor costs as well. So, but that's the price of being in business, is you are in a competitive market. Like, you must compete to attract and retain employees. And that is what I think a lot of small businesses in particular don't understand, is that the balance of power has switched to the employees. For the overall economy, and I don't think this is a bad thing at all. I don't think this is a bad thing at all. So I'm pretty not enormously happy about the stress that it's putting on the businesses that I'm involved with, but for the general economy, I'm a lot happier about that. So what does this mean? They're not looking at layoffs here. They're just saying they're going to slow hiring, and that is essentially the headline that seemed to cause all of the market gain to evaporate. Netflix is kind of on the fence here. I think this is going to be another sign. And let's be clear, I don't think Netflix should be viewed as a bellwether for the economy for any degree. It's an interesting stock, but Netflix is in a position where it's just the most recognizable name in streaming because they were kind of the first one to do it. But they never had any proprietary technology or business model that couldn't be copied by anyone else. And that is certainly being copied by everyone else who wants to get into streaming right now. And they just have a lot more competition in terms of signups, right? But the real competition right now has gone from where they were the only people that were providing all of this content before. Now they have real competition in terms of who's creating original content. And they are, there's a ton of Netflix shows out there that I really enjoy, but a lot of the large properties where you have universes to develop in, and a built-in fan base where you can create sequel after sequel after sequel to keep the fanboys interested. A lot of those are owned by Disney. A lot of those are owned by other streaming networks. And I think that the cost of original development and the risk that you take when it comes to original development in terms of content is going to add to the problems that Netflix has. So I still think it's a great company. If you're buying into that stock, I think you should just be prepared for a ton of volatility, and be prepared that this is one stock that may not be a long-term hold. You may want to buy and trade this one in waves. So I don't hold this as an individual holding in my portfolio. This is one company that I held for about a decade, and roughly a decade. Ended up selling it off when it started to get more and more volatile, and they had more and more competition. It's not that I don't believe in the company; it just doesn't fit into my investment philosophy at this point. So, but stocks have been rebounding off of their low points in June, and I think it's largely because certain expectations in the market have been baked in at this point. So, the most concerning headline today is this right here, largely because the housing market is such a large part of our economy that people that are focused on stocks a lot of times don't necessarily watch this or pay too much attention to it. This isn't a headline from today. It's actually it is from today, July 18th. So builder sentiment dropped 12 points to 55, according to a new monthly survey from the National Association of Home Builders. That is the largest single month drop in the survey's 37-year history, with the exception of April 2020, which of course was all about the COVID. Sentiment about current sales conditions saw the largest drop, while buyer traffic fell firmly into negative territory. So I don't think this is going to mean that builders are just going to stop building altogether. I do think that it means that in a lot of markets, this has priced people out of this has definitely priced people out of the market. If you look at the median home price in the county where I live, is for a median price home is just over $1 million. I do expect that to drop here in the near future, simply because of buyer affordability. I also saw indications here in the data that foreign buyers are coming back into U.S. markets pretty big here, and a lot of the money is coming from China because kind of the expected cratering of the Chinese property market there. Now, I haven't been to China in a while, and I do read reports and newspaper articles from there, so I'm not sure how clear a picture I'm really getting of what the Chinese economy is like. but I do think that their economy is probably top heavy in terms of real estate, and some of that money is going to end up here. What that does to U.S. markets remains to be seen, and I think that it doesn't help that the cost to borrow money has gone up by 40 or 50% in the last couple of months. And that is literally, it's about $500 per $100,000 that you borrow. That's a significant increase, and it's priced a lot of people out of the market. So I'm going to take a look at some questions here. Let me see here. Regarding oil, hedge funds and institutions have been the seller pushing prices down. The commercial market is still strong for now. So that is true. It's also just part of the natural ebb and flow of the oil markets, and some of it has to do with timing. Yeah. So okay, let me. I'm gonna address this here in just a minute. So yeah, that's actually true. Part of it's just the natural ebb and flow. Part of it is the end of the July 4th holiday in the United States. So there is a measurable increase in consumption around July 4th. But it's not the monstrous increase in consumption that the market wants you to think it is in July 4th. Oil futures always kind of hit a peak around July 4th, and then there's a little bit of disruption. Around August, you see an expiration of a huge batch of futures, and then you'll probably see gas prices kind of level off after that, unless we see further disruption of supply. In the wintertime, I expect us to see serious issues in the natural gas market. Meaning that unless the United States and other countries really step up deliveries of liquid natural gas to Europe, it's going to be a cold winter in Europe. So, yeah. And, but U.S. natural gas is rebounding despite losing 20% of export capacity by the Texas explosion. Yeah. We'll see. I'm not sure that, Eric, I want to say thank you for the super sticker there. I always appreciate it when you guys give me these super stickers. It's amazing. I always appreciate it really when I get them from other places too, like that the Canadian dollar. I got Romanian lions at one point. I've gotten a few other currencies, so I think it's pretty interesting. So thank you so much. Big news here. News flew under the radar for some people. But SoFi did fairly well today, or at least it did the last time I looked at it. It was over $6.50 a share. And I'm going to announce this here. I actually sold puts on SoFi. And I sold some August 19th puts at roughly $5 a share. And I don't remember. I think I sold 10 puts. So it only generated like $180 in premium. But I'm happy to own SoFi at $5 a share. I'm not happy about the reverse split. And typically because after a reverse split, the stock continues to decline by roughly 15 to 25% before it stabilizes and recovers, right? If it recovers. But let's also talk about this. SoFi is going to need to raise additional capital at some point in order to satisfy the plans they have for acquisitions. They also need to start demonstrating that the acquisitions they have made are contributing significantly to the bottom line. So I am really sort of anticipating their year-end numbers, and that'll be January or February before they put those out. That's going to give me a better idea of how well they're integrating those acquisitions. I would also expect to see another acquisition at some point here in the future, something to do with their loan portfolio. Excuse me. Probably something to do with their loan portfolio, and something to do with new lending capacities. They are lacking some built because right now their refi business that they weren't depending on, but they was growing and growing. That is completely dried up. So when it comes to their loan business, they're going to have to branch out a little bit further. So I am expecting some sort of announcement for that in the future. Okay, and let's see just where SoFi ended up at the end of the day here. And because I haven't looked at it in a couple of hours. So SoFi ends the day at 635, up 6 cents. At one point, it was up at like 655 per share. I wouldn't be completely surprised if after the split or the reverse split is actually verified that we see a further decline in price. Typically, this is not good news for companies. Okay. Sometimes it works, sometimes it doesn't. and there are hundreds and hundreds of examples of reverse splits for companies where the stock continued to decline until the company is worth basically nothing. The difference between SoFi and a lot of those other companies is that SoFi is actually a revenue growth story. They have continued to grow revenue consistently for the last couple of years. Their businesses are becoming more closely integrated. I do own a lot of this stock too, so I'm not unbiased, and I'm down fairly significantly on this stock as well. But I am prepared to own another 1,000 shares of the stock at $5 a share and to be happy to do so, because I am convinced that this company has a fairly bright future. They are building a pretty affluent community that has some serious high dollar relationships. So that's one of the things that I'm looking at here. So, but back to this news right here. This news about home builder sentiment can be pretty volatile as well. So 1 month doesn't mean all that much. I mean, it is significant, but look what happened in 2020. A huge drop in 2020, and then home building just continued like gangbusters in that time period. One of the things that has been concerning is that we've already seen a pretty large drop off in anything that could be considered middle class or affordable housing. And most of the new housing starts, or the vast majority of the new housing starts, have been in the luxury market, things that are priced over $600,000. So, and this is what they say in this report, is that affordability is the greatest challenge facing the housing market. Anecdotally, I was just having a conversation with someone this morning talking about a person that they hired to manage a portion of their business. They paid them what I think was a respectable salary, and they're having trouble just being able to afford a 1 or 2 bedroom apartment here in this area, and they're probably going to be forced to live pretty far away. And that's one of the other things I kind of wanted to talk about. We're in a strange period here where we have rising inflation. We have no problems with employment at this point. There are twice as many jobs out there as there are people applying for them. And a lot of these jobs are high quality. A lot of them mention work from home. A lot of them are high paying jobs, and a lot of them offer a lot of upward mobility. And a lot of them are in new areas where it's kind of like back in the dot-com boom, where you were hiring anyone who was interested in computers at that time, and you would teach them the skills on the job. The market has changed a little bit. I know a couple people in the last 2 or 3 years who came from outside of the IT world in particular. They really didn't have a lot of experience in computers. They went to these coding schools, and they were immediately offered, first-time jobs in the $80,000, $90,000, $100,000 range. This is one of those time periods that's kind of rare in history, where labor has a lot of power, but it doesn't have a lot of power if you stay at the same company where you work. It's always been true that the best way to get a raise in any company is to go find another job, right? Go find another job, take that offer back to your company and say, hey, I'd like a raise. If they don't meet it, leave. I think that today might be one of the best times in history to do that. It's just labor hasn't had this much power in a very, very long time, especially skilled labor. And this may be one of those opportunities. And this is one of the things that helps you keep up with inflation as well. It's very hard to go to your employer and say, hey, inflation was up 10% this year. I need at least a 15% raise, because I don't want to just keep up with inflation. I want to make a little bit more each year, be able to put a little bit more money away. Your companies probably aren't going to be willing to do that. Your best bet in a lot of cases is going to be to seek a new job with a new employer who is absolutely desperate to find skilled labor to fill that position. This adds to some of the headaches that the Federal Reserve is having, of course, when it comes to controlling inflation. But this is the tactic a lot of your family members who are older in the 1970s used to deal with inflation. It's one of those things that inflation can affect you in a lot of ways. It can affect your retirement, especially if you're approaching retirement. You had some ideas based on fixed amounts that you could generate from your portfolio on how you could survive. But if you're still in your working years, mobility is something you should definitely be thinking about when it comes to labor. Once somebody gets used to you, they tend not to appreciate what you bring to the table. They tend not to appreciate the extra hours that you're putting in, the vacation time that you don't take, or the extra effort you put in. And a lot of times your best bet is to change jobs. I found this out numerous times over and over and over, especially if you're somebody like me that doesn't function very well in a hierarchical structure. and you resent the hell out of the people that are above you and can't necessarily do the things that you can do technically, it may be in your best interest just to switch jobs if you don't want to go out on your own. And so I highly encourage everyone out there to consider this. If you're unhappy where you are, you want to earn more money, inflation is biting into your paycheck, be very careful about that next job offer you take. Take your time. Labor issues aren't going away anytime soon, even though we're seeing hiring freezes. Um, we're seeing hiring freezes, but I think this is more anticipatory in a lot of ways. And yeah, so it's always the first thing to react, largely because for a lot of companies, that's one of the largest expenses, right? So yeah, hold on, my mouse just died here. And I have one of those, I have a battery powered mouse that dies occasionally. So let's talk about some of the other headlines here. Or you guys fire away with the questions. And let me see here. Subscriber benefits, e-edition. And yeah, you guys fire away with the questions here. I'm happy to answer anything that you guys might have about. And I have no idea why it's pulling this up. But anything you want to talk about in the market right now, even some odd questions about subjects that you may not be all that familiar with. I had some really good questions on the last live stream that I did. Yeah, so this just came out right now. IBM earnings beat estimates. CEO tech demand says tech demand remains strong. So you have Apple saying that they're going to freeze hiring, but they're not saying anything about demand. And you have IBM saying that their earnings beat estimates and that demand remains strong. Let me see here. So Tesla's next profit is anyone's guess. Yeah, I don't be surprised when it comes to Tesla if profits are really really affected in an outsized manner. And a lot of that has to do with the technical challenges that they've had with their production facilities in Shanghai. Not technical, they're lockdown problems that they had with their facilities in Shanghai, where for a period they were only running one shift on a closed loop. And the other thing is they probably have like a $460 million loss on the books from Bitcoin. Now their foray into Bitcoin, although it was over $1.5 billion, I don't really believe that it's a serious foray into Bitcoin like Michael Saylor would be doing or anything like that. So the primary business of that business is still making cars and batteries and producing energy. So yeah, but IBM kicked off earnings season with better than expected quarterly results despite the headwinds from the strong dollar. And that's actually super important. They do probably more business overseas than they do in the United States. Yeah. Hal, yeah, I'm going to talk about this here in just a minute. I'll be right. I'll be your question here in just a second. So for the second quarter, IBM posted revenue of $15.5 billion, up 9% from a year ago, or 16% adjusted for currency. So this beat Wall Street's consensus forecast of $15.2 billion. Profits on an adjusted basis were $2.31 a share, 3 cents ahead of analyst forecasts. Under generally accepted accounting principles, that's $1.61 a share. That's solid earnings. That's solid earnings. Hold on a second. All right, so let's talk about the Google split. Will it have any impact on the direction of the stock? So in a lot of cases, splits don't really have. So we're only familiar with all of the really famous companies or highly covered companies that split. A split in the stock doesn't always result in the stock price going up. I mean, technically, there is no difference in valuation. There are just more shares, and those shares are worth less, right? But in the case of Google, I think we are probably likely to see the price rise here in the future. I'm fairly certain this is a prelude to them being listed on probably on the Dow Jones, and they would have to do that because it's a dollar weighted index. And you can't put companies that are that are $3,000 a share on the Dow Jones, and I don't know if that's going to be happening or not with Amazon, but I think both Google and Amazon might be listed on the Dow Jones here in just a moment. So that's something to take a look at. And this is a funny comment, but I'm not sure I understand. 4 to 8 HIMARS had a significant impact on Ukraine in such a little time. Yeah, I don't know if that's true or not. Like I see the TikTok videos and the YouTube videos and some of the coverage like you guys do. I don't know how much of that is real and how much of that is propaganda. We are facing, this is one of the most sophisticated propaganda wars that's probably, it's hands down the most sophisticated propaganda war that's ever been waged. And man, did you guys see the latest advertisement that the Russian government put out as a benefit for sending your children to war in Ukraine? And you can't make this up. You absolutely cannot make this up. They showed a picture of a family that bought a new car with the bonus that they got paid when their son got killed in Ukraine. Um, to me, that seems like the absolute worst way to advertise, trying to get young men to sign up for short-term military contracts is that your family will get a new car when you're dead. I think that's just absolutely terrible. But the propaganda on the other end has been far more sophisticated when it comes to targeting like Western audiences. So I don't know what's true over there, and I hope to get a clearer picture of that in the future. I'm trying to not to turn this channel into something political, though. I do think though that we are learning a lot about what is going to be spent on in the defense industry in the next decade or two as a result of what's happening in the Ukraine. I think that now is a great time to start looking at defense stocks. I think it is an incredible time to start looking at the Northrop Grummons, the Lockheed Martins, and the Raytheons and dozens of other companies, particularly Raytheon, because of their rocket technology and drone technology, atomic labs, everyone else in that industry. It's a good time to take a look at them. Another good thing to take a look at is a lot of the cybersecurity companies that really kind of specialize in government contracts. We are discovering that the cyber capabilities we were so afraid of are probably not as great as we thought they were. And but I think this is not going to have us take the foot off the gas when it comes to research and development. When it comes to our defense industry, this is only going to spur more interest in the defense industry. So, this is something that I am definitely taking a look at. I've had different defense industry stocks in my portfolio as individual holdings for 20 years or more because I worked in that industry for quite some time on the IT end. And those are kind of legacy holdovers. But you can, I think right now, looking at a defense industry based ETF might not be a terrible idea for a couple of different reasons. You don't tend to get outsized performance with one contractor over another because of the way the contract procurement system works. And because of the good old boy system, and let's just call it corruption, you do see a lot of the wealth being spread around all of these companies right now. So this is one sector that if you want to be invested in, I think it's actually a pretty solid idea to look at diversifying with an ETF. The entire industry generally benefits when it comes to like a smaller idea or some of these cybersecurity companies or especially some of these AI companies that are government contracting oriented. You may want to invest in individual stocks. I'm not going to make any recommendations here, of course. This is a YouTube channel. But I know YouTubers recommend stocks all the time. I don't do that because I'm actually licensed. And you can't do that if you're a licensed financial professional. You cannot recommend a stock via YouTube. So anything I talk about, you please do your own research and make your own decisions. So yeah. So the Saudi visit seemed like a waste of time. They reaffirmed their already planned production capacity. There is not a lot more that we can get out of the Saudis. So there's not a lot left to explore there. They're pumping as fast as they can, essentially. They already planned to expand production capacity, and they actually have to bring workers from overseas to do that. It's not like they can just turn the taps on and do that. So to a degree, you are correct. And in terms of the oil industry, it was probably mostly a waste of time. But I'm sure there was a lot more going on in those meetings besides just stuff for the oil industry. I'm sure there were arms sales being discussed, as well as the continuing conflict in Yemen that the Saudis have gotten involved in a big way. So that's not something, Saudi involvement in the Yemeni conflict is not something that gets a ton of press here in the United States, but they've been a huge customer when it comes to our defense capabilities. They've always been a huge customer, but for the past 7 years or so, they've been a giant customer when it comes to munitions. And it's probably one of the reasons why uh, our production lines for smart weapons, for smart bombs, missiles, that sort of thing. Those are always online, largely because we keep supplying our frenemies, allies. Are they really allies? In their war efforts. I'm not saying this is right or wrong. This is not a political opinion or a moral stance. This is just the fact. This is just what it is. We sell them a lot of missiles and bombs to use on the planes that we also sell them, and they use these in Yemen. So use that information as you will. Let me see here. The YouTube is the reverse. A licensed FP can recommend stocks, but unlicensed YouTubers face massive fines from our regulators, ASIC and YouTube bans. Interesting. I wasn't aware of that. So typically in the United States, a financial planner or a financial professional of any sort can only make an individual recommendation to you when they understand your financial situation in totality. So there's two standards, right? There's suitability, and then there's the fiduciary standard, meaning that you go to your random bank brokerage where they sell on commissions and they do not operate as a fiduciary. They can make a recommendation for you that's suitable, one that fits your objective, your time horizon, your tax bracket, and your overall net worth, right? I can make a lot of recommendations for someone that are not above board, and by understanding those and get the biggest commission that I can, right? This is why when you're looking for a financial planner, and a lot of people who watch this channel aren't looking for a financial planner, but if you are, you may want to look at somebody who's like a certified financial planner like me, who operates under a fiduciary standard, who may work for a registered investment advisory company where everyone operates as a fiduciary, or you can write a separate agreement with them where they must act as a fiduciary with you, where they're going to charge you a fee, like a flat fee instead of commission. So yeah. Let me see here. I just read how Saudi MBS hacked Jeff Bezos' phone and spilled his affair, sex, and caused a divorce because Washington Post published the Khashoggi articles. Truly deranged. Yeah, I read that article too, but I'm not sure how that was revenge against the United States, and why did they pick on Jeff Bezos? And let's be clear, it cost Jeff Bezos like $20 billion to get the divorce, but I'm sure he's happy to. I'm sure that he can afford that, and he's happy to pay that amount of money. I'm not sure what the point was when it comes to spilling those affair sexts. I think there was some other point there that none of us realize. None of us realize. But yeah, so it's a great question. Asking about my crystal ball. And I know that was said tongue in cheek. So where do you see the markets in 2 weeks after earnings are reported? Actually, I still see a relatively flat market, bouncing somewhere around 3,600, 38. So let's be clear. Earnings are going to be pretty mixed. We are likely headed for a earnings recession, even if we never hit an actual recession, because margins are going to be seriously impacted by companies. So we have two things putting pressure on them, and this is companies without a ton of pricing power. And let's think about this: a lot of software companies don't have that much pricing power because they deal with their largest expense is going to be labor, and labor costs are rising. They're competing with every other software company to hire the best professionals. And even when they go out and they subcontract with other companies to do things, they're employing software developers who are also all switching jobs at a remarkable rate right now, and they're climbing up that income ladder. And one of the big things that affects them and why they don't have that much pricing power is that for every 100 software developers, maybe 10 of them are good, maybe 60 of them are mediocre, and the rest of them suck. And there's no point in keeping around anyone but the good ones, right? And so the mediocre ones keep moving around until they either get better and become one of those good ones where they get a great stock option plan. And we can talk about incentive stock options at some point, but this is one of the reasons why like states like California have giant budget surpluses, is because of stock option plans. Last year, the stock market was up huge. Software did really well. A lot of these employees had to exercise their incentive stock options. They had to do that, and they paid massive amounts of capital gains tax in that time period. So this is one of the advantages that a state that's tech heavy like California has over some of the other states, is that a lot of the employees actually participate in the growth of their company. So Um, yeah, I am pretty happy about where the economy is right now, considering that I think it could be a lot worse. But regardless what happens, you're going to see a lot of companies that are dependent on importing materials. You're going to see their bottom line impacted as their prices are rising faster than they're able to pass that on to the consumer. So they have to pass that cost on to the consumer. You can't have declining revenues forever. You can't have declining margins forever. And we're not seeing declining revenues with a lot of companies. We're seeing margins being contracted right now. And so I do think you're probably looking at an earnings recession, even if we never actually go through an official recession. So crystal ball, I say that in 2 weeks, there's going to be a lot of mixed information that comes out here in the next earnings seasons. Like Goldman Sachs's earnings were fairly mixed. They beat expectations handily, but revenues are actually down compared to last year. I kind of stated the reasons earlier in the live stream for that. It's to be expected, but yeah, I think that we're going to and look at Bank of America's earnings. They missed earnings, but their underlying business still remains strong. We're looking at IBM having they're beating earnings, and they're saying that the tech demand remains strong. I think we're going to see a mixture of good and bad, and it's been a while since we've seen that mixture of good and bad. And Bank of America's profit misses estimates. I think that may be a pretty careful headline. It may be that the profit misses expectations, but their revenues didn't. So, and this is a good thing too, because credit spreads have exploded for financials. And I've said this before that in high inflationary environments, financials tend to do fairly well compared to other stocks. And this is because credit spreads start to increase. And let's talk about that. So Bank of America shares rose on Monday. They posted mixed second quarter results, but said that net interest income could increase by as much as $1 billion in the next quarter. And that is almost all due to the difference between what they are paying you for money you're putting on deposit versus what they're charging when they loan it out. It used to be that spread was so razor thin that banks absolutely just did not want to keep these loans on their balance sheet. They didn't want to assume the risk, and they were securitizing them as soon as possible. And in some cases on their higher quality loans, because there's no spread in that, they're actually losing money on those higher quality loans. And they just make money off of the origination fees. That is likely to change here in the future as they'll start retaining some of those higher quality loans with folks who have really good credit ratings, or they are secured loans, or they're probably going to keep more of those on the balance sheet and try to get more interest income. So they reported earnings of 73 cents a share. Analysts had averaged out expectations about 75 cents a share. And a year earlier, Bank of America earned a profit of 1.03 per share. So we are seeing year over year earnings decline, but revenue increased 6% to 22.7 billion, in line with consensus estimates. This is truly mixed numbers here. So trading revenue in the second quarter rose 17% to 4.2 billion, including net debit valuation adjustment gains of 158 million. So net interest income, or NII, jumped 22% and to 12.4 billion, thanks to higher interest rates and loan growth, the bank said. Non-interest income, however, declined by 9%, reflecting weaker capital markets. This is what we're going to see for almost all of, and this week is really financials heavy when it comes to earnings. I think this is what we're going to see for the entire week. It's a mixed picture. It is absolutely a mixed picture, and it's kind of the worst news. I like things to be one way or the other. I want them to either be all bad or either be all good. But unfortunately, or actually kind of fortunately for the economy, as a whole, this is a good sign, right? But yeah, let's take a look at this. What to buy right now. This is something that I never cover, are these articles right here, but let's take a look at that for a second here. Let me see here. And are they actually going to say that Todd Aslan looks worse? Where are the best opportunities? Okay, man, let's get to the point, guys. Okay. Applied Materials is what they're saying. Verisk Analytics, a data analytics company for the insurance industry. Actually, that's another industry that you may want to pay close attention to. And we're going to see earnings come. And this is something you don't pay attention to normally. Most folks on my channel don't. I was licensed to sell insurance for a very long time and and here's the thing. I never believed in some of the insurance products that I was licensed to sell. And because I dove deep into the prospectus, read about all the fees and things like that. But I got really interested in the insurance industry as a whole and started looking into that. These folks are the best money managers on the planet. It's not your hedge fund folks. It's not, your uncle who invested in individual stocks. Insurance companies are the best investors on the planet. They target a return and they rarely miss those returns. And these aren't guys that are saying, I'm going to invest and try to make 20% a year. They say, no, we have obligations that necessitate that we make 5% a year on our investments. Our target is 6.12% or whatever that target is. And they are the absolute best at doing this. And they've been doing this for hundreds of years, for like 400 years, basically since the rise of the modern insurance industry in the 1600s or so. Yeah. And Patrick, I'm going to get to I talked a little bit about Netflix earlier. I'm going to do that. So, but when it comes to the insurance industry in bad times, so banks go under all the time. This is the reason why we have the FDIC. This is the reason why it's a federal company. It's a company, rather, insurance company that is implicitly backed by the federal government and now explicitly backed by the federal government after 2008, where they stepped in to really rescue the FDIC because they didn't have the assets to actually back all of the banks that went under. So the government actually stepped in to do that. So that was an open question before as whether or not they were explicitly backed by the federal government. Now we know they are. So the insurance industry has never had that issue. In fact, they are generally funded in part, are guaranteed in part by state insurance agencies that guarantee that that your insurance policy will pay out if everything is met. Not that any particular company will survive. The state agency there is there to whoops, hold a second. The state agency is there to make good on claims of companies that have failed, usually through liquidating the company's assets, or make sure that those policies are bought by other companies in the interest. It's an inherently more stable industry than banking is, and yet they're involved in the same investment space. And a lot of people ignore these companies because they don't understand them. These companies have giant multi-billion-dollar portfolios under management. Anywhere from $4 billion to $100 billion under management. They are investment companies that sell you policies, and they back those policies with an investment portfolio. And they do a lot of it through fixed income trading, but they do own stocks, they own properties, they own other types of assets as well. Pay very close attention to insurance company earnings. This is very important. And companies that serve the insurance industry as well tend to do fairly well once they're established. So this is not necessarily a terrible thing. I don't know anything about Verisk, but I just wanted to go off on that tangent a little bit and talk about that particular. So Todd Aslan's picks for what to buy now, and these are not mine, by the way, are Verisk Analytics, Marsh and McLennan, and Intercontinental Exchange. And Marsh & McLennan has been around since 1905 as a $76 billion market cap. It's the world's leading insurance broker and risk advisor and has demonstrated consistent growth through cycles. The stock trades for 22 times the next 12 months earnings. That's dirt cheap. Risk management insurance service business is 61% of sales and 29% of operating margins. It has about 51% of revenue coming from Marsh, a leading brokerage, and 10% from Guy Carpenter, specialists in reinsurance. Reinsurance is another one of those super specialized industries. And I could talk about that for hours, but I'm not sure anyone's prepared to. If you ever want to nap, I can talk about the reinsurance industry. It's actually absolutely fascinating. But I'm not going to bore you guys with that today. And so, Patrick, I talked a little bit about Netflix, talking about how I directly held them for about 10 years, and I don't hold them anymore. I sold them kind of at a high point, and now I still own it through ETFs, of course, through my mutual fund portfolio. But they face challenges largely because they were the first streaming company out there. If you're a little bit older, it's kind of the only one you can name off of the top of your head right now, and everyone else is relatively new, but they never had a special technology or special business plan. They were just there first. They grew their market share the most, and then they started going into original content once they started having competition. So kind of the issue with that right now is that a lot of other companies, like even CBS owns like Star Trek, right? They're producing content on their channel. Is it CBS or NBC? I don't know which one it is, but it's owned by one of those companies. The issue with Star Trek, it's got a built-in audience. You're going to get a million eyeballs on every episode of everything, kind of no matter how bad it is. I mean, look at all the people that complained about like Star Trek Discovery, and it's still a commercial success as a television show. And they keep producing these properties because they have that built-in loyal audience over time. You know, Disney has the MCU and Star Wars. Netflix is relying on original content, and they really haven't developed that universe of ideas that they can produce sequel after sequel after sequel and just keep bleeding that that thing dry, right? And so they're having to spend a lot more money on original ideas, and not all original ideas are going to be successful. I mean, there's all kinds of jokes out there about what gets greenlit by Netflix. It's almost everything, but everything that doesn't work is a complete waste of money in a lot of cases. So Netflix, I think, is going to be challenged. It's not that I don't think it's a great company. I think it is a great company, but I'm not sure that it's going to reach the heights that it did before. But I'm fairly certain it's not going to meet the expectations that I have for owning an individual stock over time. If I'm going to take the additional risk of owning an individual position, I generally only let my individual stocks be about 30% of my overall investment portfolio, not my overall net worth, just my overall investment portfolio. And anytime a single stock gets to be more than 10% of my overall net worth, I have to cut what I own, even if I really like it, even if it's Tesla, even if it's Google, even if it's Apple, whatever, which I've never really made it big with Apple. I've kind of missed out on that train for a number of different reasons. But the issue with Netflix, though, is it's just probably not going to live up to the expectations that I have. Like, I want to get north of 12% annual return on average over a 10-year period. I don't think that's going to happen with Netflix going forward. And a lot of that has to do with competition and how much more they're going to have to invest in original content because they don't own some of the best franchises that are out there. So so Netflix, I definitely am mixed. I could definitely be wrong on that. That is that's definitely like crystal balling it in the future. You shouldn't trust anyone's opinion on this, even mine. So Eric M says defense and oil stocks are below what they were during the start of the invasion. Yeah, they are. And that's it. The prices on certain things always spike at the beginning of any conflict that grabs our attention. And I kind of said this from the beginning that in terms of economic importance that Ukraine has, it is, and in terms of strategic importance, it's not as economically important or strategically important as the rest of the world is making it out to be. It does seem clear, though, that one party in this war wants to use famine as a weapon against the rest of the world. Hold on a second. Thanks, Jason. I was more concerned with ER viewers and Microsoft. Yeah, Microsoft's a big player there. I'm not sure. Maybe I'm just having kind of a senior moment here. But what are you talking about when it comes to ER viewers? Clarify on that. So, one of the other things that we should address is the metaverse going to actually change entertainment in a way? So I have not run out and bought, even though I talk about the metaverse every once in a while on my channel, and I'm paying close attention to investment opportunities in the space. I have not run out and bought a VR set or anything like that to interact in Facebook's or whatever metaverse it is out there. And I definitely don't play any Roblox, although I do play some of the Unity games and some of. I'm not a massive gamer, guys, so I rely on the opinions of people that are more in tune with that community to see what is hot and what is not. But the metaverse is going to take a longer view on this. But Microsoft may be kind of leading the charge on metaverse entertainment. And I want to see how that evolves before I start making any investments in that. So if you guys have you guys paid attention to all of your favorite stocks that are beaten up right now? And I want you to explore the idea of leaps, right? These are basically deep in the money calls where the expiration is over a year. Like in 2020, I think I made like 157% on Microsoft leaps that I bought like in April of 2020. It was ridiculous. And, I bought deep in the money calls. I made like 157% on them and sold them out. Before that 1 year was up, I ended up selling the calls before the 1 year was up. So I ended up paying the full load of short-term capital gains on that instead of long-term capital gains. But if you're holding it to expiration, sometimes you have to hold it to expiration and expire because there's no market for a call that is that deep in the money. But a lot of times you trade it away before that time period is up because you're up 100% or something like that. And I'm not saying do that again with Microsoft. I'm saying look into company stocks that are possibly unjustifiably beaten up, particularly the ones that have been profitable for years, and particularly ones in the financial space right now. There is massive opportunity for leaps in the financial space. A year from now, 2 years from now, these companies are going to be doing a lot better. Not that they're doing poorly now, but they're going to be doing a lot better because there's going to be this giant spread in interest rates, and they're going to be making interest income hand over fist. Yeah. Okay. Earnings in next week expect to lose 2 million viewers, and Microsoft is making an ad service for Netflix. Yeah, I do. I don't know if they're expecting to lose 2 million viewers. If they are, they pretty much all went to Disney and to Hulu. But I'm not going to pay too close of attention right now to how many viewers are gaining and losing at this point, because I think that number is going to ebb and flow as popularity wanes and waxes for different things. So, hi Jason, why deep in the money? So deep in the money means that you have you look at the delta, and a delta close to 1, like around 0.89 or something like that on a leap, is not just in the money for leap calls. Yeah, no, you want them deep in the money, because you're looking at the delta there, right? The delta of 0.1 of like 0.89 means that for every $1 that the stock goes up, that leap is probably going to go up by 89 cents. So if you're buying a deep in the money call where you use like 40% of the money, 30% of the money sometimes to buy that call that you would have on the stock, you're really magnifying your earnings, and your break even is going to be sooner. Like if I bought a call right now at 22 years from now for SoFi, which is out of the money, number one, even if we look at time decay, I'm not going to make any money on that. Right. I'm not going to make any money on that because it's out of the money at this point. But even if it was close to the money and the stock remained flat, I would simply be relying on time decay there to make money. So deep in the money, you have two different factors working for you. You have time decay for the option, where its value is going. If it's deep in the money, the value is actually going to increase the closer that all things being equal, meaning that it remains the same. If it's deep in the money, the value is going to increase as you approach that date. It's the opposite, of course, if you're buying it. If you're selling it, I'm talking about buying it. And if it's 0.89, the delta is 0.89, it's going to go up theoretically 89 cents for every $1 that the stock moves. So that's why you buy the deep in the money, is that your time to break even is a lot shorter, right? So you buy a leap that's has an expiration of 2 years, likely just because of time decay at the end of 1 year, you're ahead of the game so long as the stock has a drop below exercise. And if you're buying it super deep in the money and it's a good stock, like I don't know what the price of Microsoft is today, but let's say it was $200 a share, you're buying a leaps at $100 a share. Are you buying leap for essentially half the price for a call at $100 per share? You're paying a lot of money that could evaporate, right? And I almost had this on Tesla leaps that I did years ago, where I think I spent like $20,000 for it or something, and it almost expired worthless. It really did, and I was out 2 years. It was about 18 months on that, and it almost expired worthless. And it was just barely in the money, and the math didn't actually work out for me to actually exercise the call. So I ended up selling the option like right before expiration, and made like $100 more than I would have if I had sold the call I'm sorry, if I had exercised, paid the commission, turned around, sold it, and paid the separate commission on that. This is years ago when we still paid commission. So, but deep in the money calls is because your time to break even is a lot shorter, and psychologically it's a little bit easy on you because think about it: you're buying a deep in the money call. It's gonna be highly volatile in terms of value. A lot of times, until the last 6 months or so, you are deep in the red on those, and that's when time starts working in your favors. In that last 6 months, it's really in the last 45 days. You see if it's deep in the money, you see a pretty big increase in price. So, but yeah, there's a lot going on with that. But I would take a closer look at leaps right now, where certain industries are really beat up for no good reason, and financials is one of those. And so I actually kind of hope things would get a little bit worse. And remember, it's also a form of leverage, right? I'm getting almost dollar for dollar participation in the value of the stock that I purchased that had a delta of 0.89, but generally I'm using about 40% of the purchasing power. So you're maintaining your purchasing power, and you're getting almost dollar for dollar participation in that. So that's one of the things, and it's really no recourse leverage. Like if I borrow money and go into debt or like if I use my margin to buy stock and the stock declines, at some point I can get a margin call. If I'm just using the money that I have to buy a leap, and the worst happens where it drops by 50%, in 2 years, it's down by 50%, and the money and it's down by 50%. I'm only going to lose what I paid for that option, and it's better than buying that 100 shares. It's down by 50%, and then I still have to sell that to satisfy, like I still have to sell it at that point. So yeah, it ends up working out better for you. The thing is, if you're not patient, if looking at red on your screen every day really bothers you, don't do it, because you'll sell out. You'll get discouraged and sell out of the leap before you really benefit. This is one strategy where patience. It's not one strategy. In most strategies, patience is your biggest virtue, but particularly with this strategy, patience, you have to have that as a virtue, or you're not going to make money. You will panic and you'll do the wrong thing. So yeah, but that's the reason why it's always deep in the money. And when I buy leaps that aren't deep in the money, those are the ones that hang out in the red much longer. But yeah. All right, guys, we're coming up on an hour today. And I had more people than usual on here, the live streams. I wanted to thank you guys for showing up. Wanted to thank you again for Eric M for the super sticker. And like I said, I don't do this for the super stickers, but thank you so much. It always shows that you guys appreciate what I talk about. Happy to talk about any subject in the financial world. I'm actually daily, weekly involved in a lot of industry things, and on a lot of conference calls, on a lot of presentations, where I get bombarded with information that I'd be happy to share with you guys. Sometimes I just don't know if you are interested in the things I'm learning. A lot of it's really granular, and not everyone really wants to understand that. They just want the quick answer to everything. But as a financial professional, I cannot make recommendations to buy an individual stock or bond based on a YouTube. I can't do that without knowing your particular situation in its entirety. And the YouTubers that do that, I think, do that relatively irresponsibly. Not relatively irresponsibly, absolutely irresponsibly. So my email address is usually listed at the end of the videos that I make. If you guys want to contact me, feel free to do that. I get about 10 emails a day. And at least a third of them are just people insulting me, which is, I think, funny now. It used to bother me. Now I think it's hilarious. But a lot of them are good, are good questions. But if you want some of my time and you want to address me directly, the best way to do that is through my Patreon. Join my Patreon, $5 a month. Ask your questions, and then don't renew your membership if you don't want to do that. But you may be pretty impressed with the people that you meet in the Patreon. So thanks so much for watching, guys. And thank you, Patrick Mulligan, for saying this was a great session. I thought this was a pretty good session too. I'd love to get more questions from the audience next time, though. Thank you so much, guys. And you have a nice day. I'll see you tomorrow.